Welcome to Money Depth Insights. I am the finance guide, John Nell. Today, we are going to talk about how inflation quietly affects your investments, and why understanding this relationship matters far more than trying to predict markets or chase perfect timing. Most people think of inflation as something that only affects grocery bills, rent, or fuel prices. They feel it when daily life becomes more expensive, but they rarely connect inflation to their long-term investing decisions. This disconnect causes subtle damage over time because inflation does not need to feel dramatic to reduce wealth. It works quietly, steadily, and often without resistance. Inflation is not just rising prices. It is the gradual reduction of purchasing power. The same amount of money buys less over time, even when nothing feels obviously wrong. This matters because investing is not just about growing numbers on a screen. It is about preserving and increasing real value, meaning what your money can actually do for you in the future. One of the most common mistakes investors make is focusing on nominal returns instead of real returns. A portfolio may show positive growth, but if that growth does not outpace inflation, real wealth is not being created. Many people feel reassured by seeing balances increase, without asking whether their purchasing power is improving. Inflation exploits this psychological gap. Another mistake is treating inflation as a short-term problem rather than a long-term force. Inflation does not need to be high every year to be damaging. Even moderate inflation, applied consistently over decades, can erode wealth significantly. The danger is not one bad year. The danger is ignoring compounding in the wrong direction. This is where market timing often enters the conversation. People assume that if inflation is rising, they must act quickly, move money aggressively, or wait for the perfect opportunity. In reality, reacting emotionally to inflation often creates more harm than inflation itself. Wealth is not built by guessing when inflation will peak or fall. It is built by structuring investments that can adapt over time. Experienced investors understand that inflation is not an event to predict. It is a condition to design around. Instead of asking when inflation will change, they ask whether their investments have the ability to adjust, grow, or generate value in an inflationary environment. One important observation from real investing behavior is that cash feels safe during uncertain times, but long periods of holding excess cash quietly increase inflation risk. When money sits idle, it does not grow, while prices continue to rise. This creates a slow but persistent loss of purchasing power. Many people underestimate how costly this waiting can be. This does not mean cash has no role. Cash provides stability, flexibility, and peace of mind. The mistake is allowing fear of volatility to turn temporary safety into long-term stagnation. Inflation does not punish volatility. It punishes inactivity. Another behavioral pattern that inflation exposes is impatience. When prices rise, people want quick solutions. They chase assets that promise protection without understanding the risk. This often leads to buying inflated assets at the wrong time. Inflation does not reward urgency. It rewards discipline. Building wealth without timing the market means accepting that inflation will exist, uncertainty will persist, and clarity will always arrive late. Instead of trying to react faster, successful investors reduce the need to react at all. They invest in systems rather than predictions. Diversification plays a key role here. Assets respond to inflation differently. Some adapt better than others over time. A diversified approach reduces reliance on any single outcome. It smooths the journey and supports better behavior during uncertain periods. Consistency is another powerful defense. Regular investing reduces the pressure to make large decisions during inflationary spikes. It allows participation across different price environments. This approach does not eliminate inflation risk, but it prevents emotional decision-making from amplifying it. One of the most overlooked effects of inflation is how it distorts perception. People often blame poor investment outcomes on bad timing, when the real issue was failing to account for inflation. When expectations are unrealistic, disappointment feels personal. Understanding inflation resets expectations and restores clarity. Another important insight is that inflation affects different time horizons differently. Short-term investors feel it as discomfort. Long-term investors feel it as a design challenge. The longer your horizon, the more important it becomes to focus on adaptability rather than prediction. Markets, over time, tend to reflect inflation. Businesses adjust prices, wages change, and productivity evolves. This does not mean markets move smoothly or predictably, but it does mean long-term participation has historically been more effective than constant repositioning. Trying to time the market during inflation assumes precision that rarely exists. You must be right not once, but repeatedly. You must exit at the right moment and re-enter at the right moment. Missing just a few recovery periods can offset years of cautious behavior. Inflation does not wait for perfect timing. Another mistake many people make is overestimating their emotional tolerance during inflationary periods. Rising prices create anxiety, and anxiety leads to action. Without a clear structure, action becomes reactive. Long-term wealth builders design systems that operate even when emotions are high. This is why experienced investors emphasize process over prediction. They decide in advance how much to invest, how often to invest, and under what conditions changes will be made. Inflation becomes part of the background rather than the driver of decisions. Compounding also plays a critical role. Inflation compounds quietly, but so does disciplined investing. The goal is not to eliminate inflation's impact entirely, which is unrealistic. The goal is to ensure that compounding works harder for you than inflation works against you. One of the most powerful mindset shifts is understanding that inflation rewards patience differently than it punishes impatience. People who chase protection often overpay. People who stay consistent often benefit from recovery and growth over time. Another real-world observation is that inflation often feels most dangerous when it is most visible. Headlines amplify fear, but fear rarely improves outcomes. Limiting exposure to noise helps maintain perspective. Information should guide decisions, not pressure them. Building wealth without timing the market requires humility. Accepting that you cannot predict inflation perfectly removes the need to try. Instead, you focus on resilience. Resilient strategies do not rely on forecasts. They rely on structure. Over time, investors who understand inflation stop trying to escape it. They learn to live with it intelligently. They invest with purpose, maintain flexibility, and allow time to absorb uncertainty. The most successful investors are not those who react fastest to inflation data. They are those who remain steady while others overreact. Calm behavior compounds just like money does. Inflation will continue to exist. Markets will continue to fluctuate. The question is not whether these forces can be avoided, but whether your behavior aligns with reality. When behavior and reality match, stress decreases and outcomes improve. Building wealth without timing the market is ultimately about trust. Trust in process. Trust in discipline. Trust that long-term participation, supported by thoughtful structure, can outpace short-term fear. When you stop trying to outguess inflation and start designing around it, investing becomes less stressful and more effective. You move from reaction to intention. If this perspective helped you understand inflation more clearly, share your thoughts in the comments. And if you believe this understanding can help someone in your colleague or friend circle, make sure to share it with them. Education grows when knowledge is shared. This video is created for educational purposes only. For more calm, practical, and long-term financial understanding, subscribe to Money Depth Insights. I am the finance guide, John Nell, and I will see you in the next session.